I've been tracking Indian markets for over 15 years through global financial crisis, taper tantrums, demonetization, ILFS, COVID, you name it. But this latest result season is one of the worst I've ever seen. The market seems to reflect this fatigue. Nifty has gone nowhere for a year. The Nifty Next 50 is down 9%. And what's even more surprising is that this underperformance comes at a time when global markets, from the US to Japan to even some parts of Europe, have surged on the back of AI optimism, capex recovery, and reindustrialization. India, for the first time in years, is now one of the worst performing major markets. Now, before we continue, make sure you subscribe to the channel, and if you enjoy content like this, join our Telegram group for more resources. I also train people to become investment advisors, so if that is something that interests you, make sure to drop a comment. Now, let's move on. I've spoken to fund managers, retail investors, RIAs, and nobody seems to have made any money in the last 12 months unless they were lucky enough to be in the right IPO or had exposure to a very narrow set of stocks. Even defensives have failed to defend. The consensus now seems to be drifting towards modest return expectations of 8 to 9% at best for the coming year. But before we talk about where the opportunities are, let's try and understand what's going on underneath the surface. Because this is not just about valuations or profit taking. The economic data tells its own story, and it is not a particularly optimistic one. Let's start with the basics. India's nominal GDP growth, which had surged post COVID thanks to fiscal stimulus and pent up demand, has now fallen back to 9.7%. Now, that is lower than the pre COVID average of 11.4% and way below the 14% we saw during the golden years of 2003 to 2008. Credit growth has also slowed from 15.5% a year ago to 12.9% now. GST collections are rising at just 9.8% year on year, down from 11.4% last year. These are not crash numbers, but they are also not numbers that justify the kind of earnings multiples that we are seeing in the market. Consumption data is no better. Passenger vehicle sales have slowed to 2% growth. Personal loan growth has dropped to 13% from 18%, and housing loans are at 11%, down from 14%. And this is despite falling core inflation, which means that people should have had more spending power. Well, the explanation is likely deeper. Wage growth is weak, rural wage growth is just at 6%, urban corporate wage growth is slowing, and household borrowing capacity is now stretched. On the investment side, the only real engine firing is government capex. Central government capital expenditure is growing at 33%, which is impressive on its own, but new investments announced are growing at just 16% and project completions are crawling at 3% CAGR. The private sector is either not confident or not interested. And who can blame them? 8 core industrial sectors are growing at just 3.2%. POL, or petroleum, lubricant and oil consumption, a good proxy for industrial demand, is crawling at 1.5%. Even exports, which had been a bright spot in the post-COVID boom, are faltering. Non-oil exports are growing just at 1.2% CAGR over the past 3 years. Services exports, which were growing at 18% until recently, have now slowed to 13%, and even this may taper to single digits soon. Now, the big risk here is that we are running out of both domestic and external drivers of growth. Software exports and remittances, which are the two long-standing pillars of India's balance of payments, are both plateauing. IT majors are reporting just 2.7% US dollar revenue growth. The global capacity center boom that lifted India's services trade surplus will normalize in some time. And if these slow down, then India's external account weakens, which is not a good news for the rupee or for investors relying on foreign inflows to sustain market momentum. Let's also talk about corporate earnings. On paper, the profit growth is still healthy, which is 17% year on year for non-financials. But scratch beneath the surface and you'll see why that is misleading. Corporate India today is riding on margins and not on sales. Revenue growth across most sectors has slowed dramatically. Construction materials, auto, consumer durables, FMCG, healthcare, all of them are showing low single digit growth at best. Now, this is a margin led, efficiency driven profit cycle, and those will not last forever. The market seems to be pricing in a different story altogether. The Nifty is trading at over 24 times trailing earnings. So price to peak earnings, that is the more conservative valuation measure, is at +1 standard deviation of its long-term average. This is the same zone where earlier bull markets have peaked. Historically, such high valuations have almost always been followed by either a price correction or a long drawn time correction where prices stay flat and earnings catch up. Neither outcome is good for near term returns. Now that brings us to difficult but important conclusion. The market as a whole looks expensive. Future returns as a result are likely to be subdued, and this is not a doomsday prediction, it is just how the market cycle works. You don't get 12 to 15% annualized returns starting from 24 PE with a slowing economy and a moderate earnings growth. But here's where it gets interesting. Even in such sluggish macro and overpriced markets, opportunities exist if you're willing to look beyond the index. So let me share where I am looking. First, look at the sectors that benefit from a bottoming credit cycle. While overall credit growth has slowed, early signs suggest that SME lending, NBFC lending, and even retail credit are stabilizing. Some banks and NBFCs exposed to these segments may see a revival, especially if the RBI stays dovish and interest rates soften, which seems increasingly likely in a disinflationary environment. Second, stay close to government capex. Railways, defense, road, power transmission, etc. These are still seeing aggressive government spending. Now, companies with strong order books in these areas, especially the niche capital good manufacturers or suppliers to these sectors, may outperform even if the rest of the economy stumbles. EPC players with low debt and strong execution records are worth tracking. Third, niche consumer stories. While mass market demand is slowing, there are pockets of premium electronics, high end furniture, and niche personal care brands where pricing power and volume growth are still intact. The shift from unorganized to organized continues, and players positioned well in these categories are gaining market share despite broader consumption fatigue. Fourth, watch the data center and AI related capex cycle. This is not just a US story. India is seeing a flurry of activity. Data center parks in Navi Mumbai, Noida, Hyderabad, players building power infrastructure, cooling systems, fiber connectivity, all form part of this emerging value chain. Now, the big cloud players are here and they will spend. Indian suppliers will likely benefit. Fifth, manufacturing stories with tight supply chains and strong export linkages. The PLI hype may have faded, but companies that have built genuine skills in electronics, auto components, or chemicals, especially with global certifications, continue to attract business. This includes firms with backward integrations in metals or forward integrations into global OEM supply chains. And finally, a word on IPOs. Yes, many of the recent ones have been overhyped and overpriced, but that does not mean that all are bad. In fact, market fatigue often creates mispricing. A few recent listings are trading below issue price despite strong fundamentals. If you can do the work, read the DRHPs, understand the business model, this can be a fertile hunting ground for long-term positions. Now, the bottom line is this. Index investing alone will not cut it right now. Passive returns are likely to be low, but for active investors willing to stay patient and ask hard questions, there is still plenty of alpha to be earned. This is not the noughties. The days of 20% broad-based growth, export booms, and private capex super cycles are behind us for now. But markets evolve, new leadership always emerges, and as always, the best opportunities are born out of dislocations. So don't be discouraged by the noise. Use it as a filter, focus on quality, focus on fundamentals, and most importantly, focus on the price. Because in a market price for perfection, the biggest edge you can have is not to overpay. Make sure to like the video and subscribe to the channel.